Imagine you see a friend standing next to a shiny new bicycle in a store window. They really want to buy it, but they are currently short by exactly $100. They look around, feeling a bit stuck, wondering how they can possibly come up with the cash. Now, think about a massive global corporation that needs billions of dollars to build a new factory. They also need a large influx of capital to get their ambitious project off the ground. Instead of walking into a traditional bank to ask for a loan, what do they actually do? They decide to issue a financial instrument that allows them to borrow directly from investors. This instrument is what we call a bond. At its most basic level, a bond is simply a formal I.O.U. between you and the borrower. It is a structured way for organizations to raise the capital they need to grow. When you choose to buy a bond, you are not buying ownership in the company. This is a very important distinction to make, especially when you compare it to buying stocks. When you own a stock, you own a piece of the business itself. But when you buy a bond, you are not a part owner of the enterprise. Instead, you are essentially acting as the bank in this financial relationship. You are lending your own hard-earned money to a company or even a government entity. This loan is provided for a very specific, predetermined period of time. The entire agreement is carefully documented in a legal contract known as a bond. This contract clearly outlines the terms of the loan between you and the issuer. It defines exactly how much money is being borrowed and the rules of repayment. In return for your loan, the borrower makes two very specific promises to you. The first promise is to pay you regular interest payments throughout the life of the bond. These payments are often referred to by investors as coupon payments. They act as a reward for letting the borrower use your money for a while. The second promise is to return your original lump sum of cash at the end. This happens when the bond finally reaches what we call its maturity date. It is a very predictable and steady cycle of financial activity. You receive your interest periodically, and then your principal is returned in full. Think of bonds as the steady, reliable anchor of a well-rounded investment portfolio. They are designed to offer lower risk compared to many other types of assets. Because the terms are fixed, they provide a sense of predictable income. While stocks might represent the potential for high growth, bonds provide essential stability. Understanding this balance is the absolute key to building a strong financial toolkit. By mixing these assets, you can better manage your risk over the long term. It is about finding the right mix that aligns with your personal goals. Bonds allow you to participate in the economy without the volatility of the stock market. They serve as a foundation that helps keep your financial ship steady. Whether it is a government or a corporation, the principle of the bond remains the same. You provide the capital, and they provide the interest and the eventual repayment. It is a classic example of how debt can be used to fuel progress. The borrower gets the factory or the bike, and you get a reliable return. This mutual benefit is the engine that drives the bond market forward. So, the next time you hear about bonds, remember the simple bike analogy. It is just a way to lend money and earn interest in a structured way. No complex banking jargon is needed to understand the core mechanism. You are the lender, and the issuer is the borrower in this transaction. The maturity date is simply the finish line for the agreement. Once that date arrives, the contract is fulfilled and the money is returned. It is a straightforward process that has been used for centuries. Investors value this predictability in an otherwise uncertain financial world. It helps protect your wealth while still allowing it to work for you. As you continue to learn, you will see how these pieces fit together. Building your knowledge is the first step toward better financial health. Keep exploring these concepts to make more informed decisions with your savings. Bonds are a powerful tool for anyone looking to diversify their holdings. They bring clarity and structure to your overall investment strategy. We hope this explanation has made the concept of bonds much clearer. Stay curious and keep asking questions about how the financial world operates. There is always more to learn as you build your personal financial toolkit. Subscribe to our channel for more insights into the world of investing.